Namaste to all. I welcome all participants to another great discussion, a panel discussion on few very important topics related to accounting standards. Both are very, very important points. One is intangible assets, and another is impairment of the assets. And to have this fruitful discussion, we have two stalwart panelists out here, speakers. One is CA Rajkumar Agrawalji, who has been here in this panel earlier also, who's an expert into Indias, and he has done few certificate courses, including that on Indias. He has been a regular speaker on the Indias and is having more than 25 years of experience. I welcome you, Rajkumar Agrawalji, CA Rajkumar Agrawalji, and thanks for joining this today's discussion as a panelist. Another panelist we have is CA Adesh Sharmaji, again having an in-depth knowledge of the AS and the INDES, and having more than 10 years of experience, and a regular contributor to the institute on both the AS and the INDES. And to moderate these two panelists, we have none other than CA Sarthak Jain, a young and energetic member who is also an expert into INDES and AS. So he is a regular faculty also. And it is really nice, and thanks to Sarthak ji for agreeing to moderate these two panelists with your own adding of your own in-depth knowledge on the accounting standards. So thank you, Sarthak ji. Friends, sometimes we feel that for our profession, accounting standard is just a theoretical thing. But friends, let me talk it very, very seriously. That when we talk about accounting standards, whether it is AS or INDES, or for that matter ICDS, or whatever standards we talk about, IFRS, it is the basic accounting. How to account, what to account, how to recognize, how to classify, how to disclose other things. This is a very, very basic thing for the basic accounts, based on which the financial statements are prepared, and based on which the taxation depends, whether it is direct tax or indirect tax. For example, today's topic which we have, one is intangible asset. So whether the expense is so huge that you take it as recognize that as an asset in your financial statement, or you charge up to it to a revenue. So what can be recognized, what not, what are the criteria, what are the standards? Because based upon that only, you will be able to prove in the income tax also that whether it is capital or revenue. Yes, there would be standards. There are standards again borrowed from our accounting standard itself. But that basic understanding is required. Understanding is required for such expenses, and also for the impairment to reflect a true and fair view at the end of every financial year. So I'm very sure today's discussions would be very, very fruitful. And friends, all of those participants who have joined already online, I've seen various questions also which have come already. Now more than 1,200, 1,300 members are already there joined. So my best wishes, and hoping for a great session to each and everyone. And all these our webinars through the panel discussion are available later on also. So all the earlier ones are also available. They are all available on the ICAI TV. ICAI TV, if you go, where you will see ASB, and there you will find all these videos. I'm handing over to Sarthak Jain ji for making this session a great learning for everyone present. Over to you, Sarthak.
Thank you, Pramod ji. Thank you so much. I'll start with a saying of Helen Keller. She said that hope sees the invisible, hope sees the invisible, feels the intangible, and achieves the impossible. Today, I hope in this particular session, we'll help you to preempt or pre-see the impairments, to feel the intangibles, and to achieve this impossible task of covering these two mammoth standards. Because I believe accounting standard 28 is the lengthiest of the standard, followed by 26. India's, thankfully, we have financial instruments 115 and 6, which are lengthier than this. But these are big standards. And I really appreciate and thankful for ICI for organizing these webinars, because this is something which is developing our intangible asset, which the chartered accountants are known for. Thank you very much, our Accounting Standard Board Chairman, Pramod Jain sir, for giving me this opportunity to moderate this session. So I'm going to be the Sutradhar. I just picked that particular word in the term of moderator for this session. Thank you so much for it. We will be covering impairment and intangibles, starting first with intangibles and then with impairment. And we would be trying to cover most of the content of the standard, which is relevant for any practicing chartered accountant or even a person who's working in industry, whether it is relating to Ind AS or it is relating to accounting standards. So we'll focus on both. We have two very, very learned, experienced, hands-on experienced personalities with us here today. Thank you, Rajkumar sir, for accepting this and agreeing to share your knowledge and tons of years of experience on this. And similarly, R.S. Sharma sir, thank you. And I kind of welcome everybody in the audience into this particular session. Can we start with the very first question? Sure. So the very first thing is the very basic thing in terms of what are the standards which takes care of intangibles and impairment under accounting standards and under Ind AS.
Yeah, thanks, Sarthak, and good afternoon, everybody, and welcome to this session. Thank you to ICI for conducting under the leadership of Mr. Pramod Jain. And it is actually overwhelming to note that we all 1,000 people, 1,000 fellow chartered accountants are there to learn and understand. A salute to everybody for learning. So coming back to the answer, Sarthak has asked me that what are the related standards with regards to Ind AS on intangibles. So friends, intangible, as you know, is covered under Ind AS 38. Impairment is covered under 36. So impairment is earlier section, just to remember. 38, now normally there could be confusion. So 38 comes later, but that is related to intangible. The equivalent standard in accounting standard, that is IGAAP, is 26. As far as ICDS is considered, there is a specific standard, but ICDS 5 is with regards to tangible asset, but not regards to intangibles per se. You would also find the reference of intangibles in Ind AS 103, where there is a business combination. So any intangibles acquired in business combination, how do we deal with it? That is given in 103. Plus, you would have some reference like in 16, Ind AS 16 about contingent pricing, and there could be a reference here and there. But basically, coming back, Ind AS 36, Ind AS 38 for intangible asset, 26 under Indian accounting standard, and there is no ICDS.
Great. And apart from the accounting standards or the Ind AS, any other publications of the institute, any other pronouncements or guidance notes, which one should also refer to apart from the bare standards with respect to intangibles?
Yeah, thank you, Sarthak, for the question. So thank you, everyone. I mean, before I answer this question, thank you, everyone. Thank you, ICI. Thank you, Pramod sir, for making me part of this session. Again, thank you. So to answer this question, there is no any other specific guidance on intangible. I mean, other than the guidance which Rajkumar sir just described. Then ICI has issued an education material which can be referred to basically answer or to see some of the practical questions. And time to time, it was a ESU opinion. It was expert advisory committee of ICI has issued a lot of questions on intangible assets. Those can be referred if someone is stuck somewhere. So ESU opinion is a good material which someone can refer. Though, I mean, those opinions are largely, I mean, the old ones are in the hard copies. But I mean, those material is very good, which can be referred if any particular issue is stuck and you wanted to basically deep dive on the same. So apart from the AS or Ind AS, you can refer to the education material and ESU opinions issued by the ICI.
Okay. Here, one thing I like to add, one like Adeshji, what you said, the old one hard copy. No, now every opinion is available on a searchable mode.
Okay.
with on the expert advisory committee. So nearly 1,600 opinions.
Yeah.
Till date, also all those opinions issued say 15 years ago also.
Yeah.
They are available on a searchable mode. Just go to ICAI website, ICAI website. There, go on the EAC platform, EAC page. There you will find that link where you'll click, and that is called an extensive search. You put a word you want to search, say intangible or impairment. They will give you the list of all opinions. Will you click and you'll get that opinion. So that could be very, very extensively used by members at large. All those opinions and updated opinion last 3 months, any opinion issued prior to last 3 months from today, you'll get that. So everyone can use that, please.
Thank you so much for the knowledge, Pramod sir. I mean, I was aware of the recent opinions, but I was having an impression that old books are in the hard copies only. Yeah, thank you for the knowledge.
In fact, I would like to add on, sir, that IC has done a commendable job, no doubt, in terms of making the material available online. Because if we see the foreign institutes and a lot of, not to compare, but yes, it is very clandestine. It is very difficult to find material online freely, so much available. And our education material for that particular matter, the clarification bulletins, these are all excellent piece of intellectual work, which is all made available for I mean, the second largest body we are. So every professional has those tools handy with them. So thank you so much for from the ICI side, from the members side to the institute for that. So I have the next question now, getting on to the intangible assets. So because, in our school days, we've heard intangible एक ऐसी चीज है जिसे हम देख नहीं सकते, छू नहीं करते, सिर्फ महसूस कर सकते हैं. Very Bollywood kind of a definition which we have heard about. So what exactly, as per the standards, intangible asset is, and how is it different from property, plant, equipment?
So basically, Sarthak, intangible assets is an identifiable asset, and which is a non-monetary in nature and has no physical substance. So if you break the definition into two to three pieces, one is there should be identifiability. When I say identifiability, it means either this asset can be separable. When I say separable, it means it can be separated from the other asset. For example, in case of business combination, it can be separated from the goodwill. And then when I say separated, then it can be leased, transferred, sold to another entity, which represent the one part of the identifiability. And the second part is that asset is generating from the legal or contractual agreement. These two things together basically form an identifiability. And then we can see asset should be non-monetary. Monetary asset, as we all know, is in fixed term or fixed amount. We can say non-monetary is something where value of the asset is not definite, which can change because of the economic conditions or the economic environment. And then no physical substance, as you rightly says, which cannot be seen or cannot be touched upon. So these three things are there, and when these three things combine, it basically becomes an intangible.
So whether accounting standard also has such a similar definition, or is it only in the Indies?
So India basically has reduced the definition of intangible assets. If we do see AS used to have a wider definition, which says that intangible assets is identifiable, non-monetary assets having no physical substance, which is held by the entity for the production of goods and services, or for the leasing purpose, or for any other administrative or general purpose. To include basically to increase the scope or to make it wider, basically this held by the entity for the use of production or for rented or for any other purpose has been removed under the index.
Okay, so it was pretty much comparable to the PPE definition in that sense.
Yes.
Okay. And what about IFRS? Do we have similar things in IFRS as well?
So you are speaking on mute.
What I understand, Sarthak, is basically what should be actually broadly, as we know, that India's is convergence from IFRS. So
right.
All the IFRS has basically been adopted with certain changes seen to the environment and economy. So Let me tell you what are the basic difference between IFRS and India's. So basically the IFRS 38, that is on intangibles, and it is India's 38 here as we know it. Okay. So what are the gap difference, or what are the convergence difference? Let me tell you. So whenever I'm taking India's class, basically I tell everybody that there are certain basic fundamentals that can be remembered. So after Ind AS, there is always an appendix that is given. So in case of appendix, in one of the appendix, basically all the difference between IFRS and Ind AS is given.
Okay.
Now in all AS versus all Ind AS versus IFRS, there are 2 or 3 common difference. One, the difference is that the para related to transition in case of IFRS have been omitted, because for transition we have another standard 101, right? So in IFRS, the transition provisions are there in the standard itself. No, so what I'm just now telling is common for all type of Ind AS, 1 to 40, 41, whatever you call it, or 101 series and all that. So it is common to all. One, the transition provision in Ind AS is given in 101, whereas transition provision in IFRS is given in the respective standard. So that is one of the major difference. The second difference is about the terminology. Say, for example, here we use balance sheet. There in IFRS, it is used as financial position, statement of financial position. Similarly, for the profit and loss account, here we say it as a statement of profit and loss account. Worldwide, it is said as a statement of comprehensive income. So basically, these 3 differences are there in all Ind AS versus IFRS. Now, basically, your question certainly would have been, what is the specific difference? So as such, there is no major difference except in case of one, which is also, I would say, it is because of the Indian context. It is in case of concessional agreements, particularly with regards to the road concession agreements. Now, our convergence started from IGAP to Ind AS in 2016. So before 2016, what used to happen is, for the road projects, basically they were awarded based on the revenue, and the accounting of the revenue and this intangible used to be based on the revenue. Say, for example, I have incurred X amount of cost, and if there is, depending upon the projection, if I have revenue, so that percentage of revenue, whatever is there, it used to be accounted for as accordingly, it has to be absorbed. So now basically, in particularly IFRS, the revenue-based intangible is now not acceptable. So what they have done is, it has been allowed and carried forward in 101, and accordingly, an exception is given in the Intangible Index. So that is the only standard. Now, for the old projects, you can have this revenue basis. Otherwise, for the new projects or new road projects, it has to be as per the revenue, because even the construction contract has been deleted. So everything would be based on the revenue Index. So that is the only and key difference.
Okay. So, which essentially would mean that we don't have any significant difference between, except the terminology ones in times, in fact, with respect to intangibles. And there's only if you have a past road construction, private public partnership type of a contract, which you've been depreciating or amortizing using a different basis earlier, that you can continue. However,
Right.
For new projects, otherwise 115 would be applicable.
Right.
Perfectly fine. Before I actually delve into further with intangible assets, one very common question which comes up is with respect to preliminary expenses. Earlier, there used to be that we used to kind of amortize or depreciate or write off preliminary expense over a period of time. Under income tax section 35D, we still do it like over a period of 5 years. Now, how does the situation compares when we talk about Ind AS or AS? Can we still defer preliminary expenses?
Yes, see, very simple, but very very first question for any balance sheet. In this 1 lakh or 2 lakh rupees, the company incorporation expenses is the first question which any of our professional would face as regards intangible. So, friends, basically, there is one particular paragraph which is 69. Now, you can remember this paragraph 69. It has what will not be intangible. So everything is intangible, what you think, but what would not be intangible, which we'll be referring quite a few times now. So there it is specifically given. So I'm not going into the argument. There is a specifically given that any startup cost or any pre-operative cost that is not allowed to be considered, or it is not considered as intangible, because no asset is created. As Adesh told, that as asset would be a resource. So there is no resource out of which the future economic benefit would be there. So that is the logic for it.
Okay. So now we cannot have any preliminary expenses in the balance sheet recognized on the asset side.
Right.
Okay.
But we can have in the income tax.
Under the income tax.
Schedule.
So it would have its own deferred tax implications and all.
Right.
And will the same position hold true for pre-operative expenses before the company commences business?
Answer is yes, Sarthak.
Okay.
So basically, as Raj sir highlighted, the startup activity related expenditure. I mean, whether entity is incurring preliminary expenditure to basically establishing a legal entity, or incurring expenditure to basically opening a new facility. It can be in the form of promotional expenses or any training costs. These expenses are the list of expenses which standards specifically mention that should be expensed off and should not capitalize, as there is no future economic benefit available to the entity out of these.
Okay. Oh, that's wonderful. So that means now.
Here, here one point, Sarthakji and Adeshji and Rajkumarji, because this is a point which has to be understood by participants at large, and they should inform other members also about this. What Adeshji and Rajkumarji are saying, along with Sarthakji, is that for a company which is incorporated, any preliminary expenses which have been incurred, income. Now, what is happening many a times, we have seen that members are guided to account as per the income tax and not as per accounting standards. Income tax will not lead the way how the accounts are to be made. So, as an preliminary expenses, as there is no further future economic benefit which is to be realized out of it, it cannot be recognized as an asset. So what happens in the year of incorporation itself, any preliminary expenses which is incurred, it would be written off to the our statement of profit and loss. Right? Income tax, again, it would be allowed in 1/5 of whatever the condition 35, section 35D says. So one has to be very careful, because we have seen certain financial statements, today's date also, where they are writing off preliminary expenses 1/5 every year, which is not there. And same what Adeshji said about pre-operative expenses, that the company has been incorporated, but the business has not yet been set up. So any expenses prior to that, they keep on accumulating that as a pre-operative expenses. So what I could gather from the discussion right now is that that cannot also be recognized, that have to be charged to the statement of profit loss. Is my understanding correct?
Yes,
absolutely. I think
yes.
Yeah, and that requires a reiteration. Yes.
Reiteration, because this is, though one of the simplest thing, but yes, that forms the basis of our financial statements on a larger foray. So just wanted to enter for that.
In fact, thank you, sir, for that, because this is too strange to be true. That is the reaction when you first time hear this. And I would also like to reiterate that this is the same thing which is in accounting standard as well. So it's not that accounting standard permits and Ind AS does not. Both of them do not permit a preliminary expense or a pre-operative expenses to be capitalized or carried forward. So with this regards itself, because we are talking about preliminary expense, deferred revenue expenditure is another category of similar category of expenditure, which earlier used to be, those accounting principles used to be there, that they used to be deferred over a period of time. So I would like the panel to please enlighten us about the difference between a deferred revenue expenditure and an intangible asset, and even a prepaid expense, in terms of how does these three assets compare, or three expenditures compared to each other?
For the benefit of all, I think I would really like, it's a very different and very important question. They are very linked term. So what we are just now dealing with is, what is basically, if I reframe for myself, it is what is the difference between intangibles versus deferred revenue expenditure versus prepaid. Right. So intangible is defined in Ind AS 38, where of course it is an asset which would have future economic benefit. Certainly it is a resource, and it is intangible because the physical substance does not, physical existence is not there. Now, as far as the deferred revenue expenditure is there. So word revenue means it is other than capital. So I have I referred to the one of the very important institutes publication, which is now generally very less used, is the terms used in the financial statement. So there, the deferred revenue expenditure is that which for which payment is made or liability is incurred. So any expenditure for which either payment has been made or liability is incurred, but which is carried forward with the presumption. The word important here is presumption that it will benefit it in the future. Say, for example, heavy advertisement expenditure done in 1 year on, say, film making of the advertisement, which is run on 2 years. So it is deferred over the second year with the presumption that it will also benefit in the second year. Now, what is prepaid? Prepaid is an expense, the benefit of which will accrue in the subsequent year, basically. So it is divided between the 2 years. Basically, the benefit would be in the next year. So the important thing is prepaid is a confirmation rather, and deferred revenue is based on certain presumption. So that is broadly the difference between the two. And the third, intangible, is certainly totally different. And from a practical point of view, deferred revenue expenditure, friends, the concept is off now. So there is no item which nowadays can be called, except under very, very different or exceptional circumstances, that this could be a deferred revenue expenditure.
Okay. In fact, that was very insightful, sir, because very basic terms, prepaid and deferred, but a very important difference which you highlighted, that it is basically with respect to one, there is a surety, there is no estimation involved, I guess. And the second one, there is an estimation involved. But yes, particularly important because prepaid still will be asset, but deferred revenue, as you mentioned, will not be asset. So any recognition conditions on expenditures like, as we mentioned, like say, for example, we have sometimes heavy advertisement expenditure, particularly when these automobile companies launch a new model. They sometimes will do a heavy advertisement, or a foreign company establishing their business in India, again, would do heavy advertisement expenditure. Sometimes you also have a non-annual kind of a training fees, what aircrafts could provided to their pilots and all. So these kind of non-recurring heavy expenditure, will they ever be recognized as an asset in the balance sheet? And would that be an intangible asset?
Yeah, I think whenever we are discussing about intangibles in DES 38, this is the fundamental and one of the very key question. Again, remember para 69. So para 69 is specific. So let me give you first the theoretical answer, then the logical answer. So theoretical answer, it is specifically all these items are specifically excluded and effectively given in para 69 as an exclusions. So I think to avoid argument or something like that, probably the ISAB would have preferred to give it in black and white type. But let us consider the logic. The logic is broadly that no intangible is acquired. Basically, when you say that if I advertise, it will give me revenue. But the question is, when an intangible is acquired, there is another word which is very important, that is control. So whenever we say that if we have an intangible, there you would have a control on it. Now this control would mean that you are able to use it for your own benefit. Now, if you advertise, you can't control the sales, basically. That is one of the logic. Plus, you cannot say that if I advertise, my sales would be higher or lesser or something like that. So it is very different. Again, then identification is again an issue. So when you advertise, it is a different thought process, but an identifiable resource. So all these logics basically go to the factor that yes, all these type of expenses, including the training expenses, they would not form part of intangibles, and they have to be written off in the year of incurring.
Okay.
Yes, sir. Sir, I think Pramod sir is intending to update on that, because this is also one of the critical problems I know in the finance.
Yes, that's why. Because sometimes it happens that again the assessee feels that the amount of expenditure is huge, so let me not book it through statement of profit loss. and let me take it to the financial statement and amortize over specified periods. Normally they take it 5 years. But just for the discussion, and the experts are all here, all the three out here. When we talk about expenditure, it is an expenditure. Only when that expenditure is there with a precondition for a specified year, like the example, like the question which Sarthak said, prepaid expenses that you have paid, say, for an annual maintenance contract for a period of 5 years. So that is to be spread over 5 years. I have something made a prepayment, but where I made an expenditure, say, on advertisement or certain campaign, whatever it may be. So those expenditure may be having a long-lasting impact, but those are all revenue expenditures. Because those are all revenue expenditures. So that has to be charged to the statement of profit loss. You have to go as per accounting standards, and while auditing, please take care that everything is not as per income tax. But yes, again, even in the income tax, you have to be very careful what is revenue and what is capital. Again, the standards are same there. For capital, for a property, plant, equipment, it has to be the same. There ICDS 5 is there, or AS 10 is there, or India 16 is there, whatever. The accounting will be done like that only. And for PPE, for intangible, already 38, 36, and 26, 28, we have already talked about. So it is not that the amount is huge and you can just take it as, to the capital account. One has to be very, very careful about it. I just wanted to reiterate that. Nothing more than that, because you have all talked about it.
Right.
Yeah. ERP implementation. Another question which is coming: what about ERP implementation? Software expenses, are those intangibles? Yeah, those may not be embedded into our questions, but just off, on the spot question, because they are those questions that have been asked by various participants. So what is your view on this software in ERP implementations?
Again, sir, they fall under the same category. Their use can be for different years, but certainly they are not intangibles, basically. And further to that, for a clarification, sir, as we know, there is an appendix even for the website. So even in the case of website, if you are able to generate revenue from website, then you can create an intangible of it. If no revenue can be generated from website, it only supports the business, then again it cannot be capitalized. So anyway, the ERP implementation expenses, basically it's a if it is a in case of ERP, if it is a one-time cost together with the whole as it is, then of course we can take it as that it is the entire ERP cost, which is for 1 year, 2 years, or accordingly. Otherwise, and the training particularly for the ERP would not be added to it. So that is my view, sir.
Yeah. In fact, yeah.
The other panelist and moderator agrees to that.
Adesh.
Yeah. So, sir, in respect of the what I believe, the expenditure incurred the implementation of ERP can be relooked, and I believe this can be capitalized with the overall cost of an ERP.
Sarthak, your views?
Yes, sir. So I think it's a question to be taken in context. So in case if we definitely are doing an ERP implementation, it should cover under the development phase of this particular standard, which says that if you are creating something on your own, until your asset is ready for use, what we have in PP, we have a similar concept here. So if that expenditure qualifies to be under that particular stage, then definitely it would be added to the, as the panelist mentioned very correctly, to the respective ERP asset itself. However, if it is a standalone expenditure, which usually would be unlikely, because as the name suggests, ERP implementation, usually we will presume that it is along with it. But in case if it is more of a bug fixing or something in the corrective nature, then it may not fulfill the conditions of recognition of generating future economic benefits beyond and in addition to what the asset is already doing that. So I think it would be a contextual answer depending on at what stage we have incurred this.
So in a broader sense, just for the participants at a large to understand this, is that if it is a software creation or basically the basic cost of the software. There was a thought process among some of the tax practitioners, because software earlier was treated as a royalty, and then said when it is a royalty, it is a revenue expenditure. Now that though it is said to be not a royalty now because of Supreme Court judgment, so no TDS is deductible thereon. So earlier, everyone used to, some of our members used to say it is a revenue expenditure, but no, it is merely, if it is a royalty or TDS is deducted, it doesn't make a capital or revenue. For capital or revenue, it has to be the accounting standards of the Indias. So very rightly pointed out by all the panelists and the moderator, that in case of the initial cost for owning that software, initial cost for implementation of ERP or even any other software, that would be an intangible asset. And again, amortization we'll be discussing, the panelists will be discussing later. But the annual renewal fees, annual licenses fees, or just improvement or debugging and all those, that would be revenue. But very one important point which Rajkumar ji mentioned, and which might have been missed by various of our participants, in the case of website costs. If the website itself is generating revenue, then Rajkumar ji said that only in that case it would be taken as an intangible asset. Otherwise, it should be charged off in the year of creating that website. Views of other panelists on this, because this is an important point for all our members.
Absolutely.
Adesh and then Sarthak ji both.
Absolutely right, sir. In the case of website, when it is probable that future economic benefit will be increased. For example, the website was allowing only option A earlier. Let's say it was allowing the hotel booking to us, and now we are increasing to basically do the airway booking also, or the hotel booking also. I mean, if these kind of things are being enhanced through a website, then we can say the future probable economic benefit will be increased, and we can capitalize this.
No, Adesh, I am not talking about a website which is taking orders and then revenue. I'm talking about, say, a listed company's website which is giving information, or say a chartered accountant firm which is creating its own website. So all those websites which may be dynamic, which could be static, so they are not revenue generating.
Yeah.
Though ultimately it's brand image, through with that we are making ourselves available on the social media, and we get that credibility out there and marketing and all those things. So whether these websites should be charged out to the revenue in the year of the cost incurred, or it can be taken to an intangible asset as per the yes.
Yes.
नहीं, राजकुमार जी का तो क्लियर कट कहना है, उनका तो कहना है कि because they are not revenue generating, charge up to the revenue. Views of the rest of two.
I mean, it's a tricky one. I believe that if it is not generating revenue in terms of the money, I would say, and though it is enhancing our brand value, it is enhancing a lot of governance, but in terms of the economic benefit, in terms of the money, is not there. So I believe, I mean, though I might be wrong, I believe should be charged to PL.
So my views, I will kind of take the leeway to compare this something with what is given in PP. So I would reiterate the words what Adesh said earlier, that in this definition, what we have in India is the term that is held for production of goods, rendering services, administrative use has been skipped, particularly in the intangible assets definition. But if I use PP as a corollary to compare asset per se, recognition of asset per se, so PP, they say that even if a PP is for administrative use, you can capitalize it as an asset. So taking that particular thing as an example, if I just have a painting which I fix at the director's cabin, which is not giving me any revenue, it's just a Mahatma Gandhi painting which I bought for, let's say, lakhs of rupees, very heavy expenditure. But still, because it is coming in my office use, I would still be eligible to capitalize it as a property, plant, equipment asset, because administrative use may not directly help me in generating future economic benefits. So there may not be a direct correlation with that, but indirectly it is a part and parcel of my business. Hence, it is for administrative purpose. So with that context, let's say, for example, if I have an accounting software simple like Tally, it may not help me to generate revenue, but help me to account for, comply with things, do my financial planning, and become or provide a base for it. So in that sense, even administrative use is a benefit to that particular extent. However, this of my thought is more, open with respect to the general terminology of administrative use and not specific to the appendix per se. So I just have that submission to, kind of add on to this whole discussion.
Rajkumar, you want to add something to that?
Yeah. See, so intangible has a very different footing, as you know. And basically, the standard setters have tried to safeguard, particularly the wrong accounting. Probably impairment is basically is also from an safeguarding wrong accounting, because nowadays, as you understand, that together with tangibles, there are a lot of intangibles. So it is basically a safe accounting as well. And again, we have to understand one important thing. Anything which is adding to the brand, intangibles, not tangible. It is difference. That is the basically difference between 16 and 38. So intangible, even if which is adding to the brand, and brand is considered as internally generated, which is a type of goodwill. So accordingly, also that is also one of the reason why all these expenditure, what we discussed, like even heavy advertisement and all these things, they are not allowed to be capitalized or allowed to be part of intangible. So over to you.
Good discussion. Let us continue, because other questions would be on, again, coming on that amortization and brand. So let us take at that time.
Yeah.
Continue.
Great, sir. So you created
good discussion. Thank you.
You created a great debate out of it. Interesting.
Yeah.
Great. So, because we are discussing intangibles, and I think, these are more critically things, which will affect most of us during our practice or professional career. So just adding further onto it, like, because we are talking about intangibles, let's say, for example, we are clear that any deferred revenue expenditure does not exist. Any heavy advertisement expense, just for the sake of the quantum of it, unless and until it satisfies the definition of asset, which sir very rightly pointed out, Rajkumar sir, that control element missing, so it cannot be an asset, will not be recognized. So can I conclude that in my balance sheet on the asset side, any particular asset which is recognizable as an asset but is not having a physical substance to it, can I say it has to be an intangible asset? Or let me also put it like this, that assets in the balance sheet without physical substance, recognized in the balance sheet, but are they any such assets which are scoped out from the context of Ind AS 38 intangible assets? And also, apart from this particular thing, if, say, for example, there is a comparison to be done between lease and intangibles, let's say, for example, I've got a motion picture film license to broadcast. Would that be treated as a lease under 116 right of use asset, or would it be treated as an intangible asset? So it was a very lengthy question. Just to summarize it, sorry. One, asset side in the balance sheet not having physical substance would definitely be intangibles or something scoped out. And specifically intangibles and lease, what should be the correlation like?
Yeah. Yes, sir. So basically, in the financial, there are many assets which are non-identifiable or doesn't have any. I would say not identifiable is not a right word. Which doesn't have any physical substance. For example, we can say the deferred tax is one, wherein deferred tax is not having any physical substance, but we cannot say it's an intangible asset under the scope of Ind AS 38, which is not right. So there's a specific standard Ind AS 12 which deals with the deferred tax. Similarly, there can be case of a lease of intangible assets. So lease of intangibles is specifically dealt by the PPA standard. So assets can be there which doesn't have any physical substance but are not intangible assets as per Ind AS 38. And from the scope out perspective, there are other assets which are scoped out of this standard. For example, apart from deferred tax and lease of intangible assets, there are financial assets which are scoped out of this standard and specifically covered in Ind AS 109. Then goodwill, which is arising from a business combination, we are specifically dealing the same as per the requirement of Ind AS 103. And intangible assets which are classified as held for sale, where intention of the entity is to recover the principal amount through a sale. So those assets are scoped out of this standard, and specifically measurement of the same is being done as per the requirement of Ind AS 105. So, and there can be another example also, intangible assets, which is arising from an insurance contract. So specifically being dealt by the insurance contract 104 standard. And to answer the question on the IPR right, IPR owner basically transferring us the musical right or similar right, these are specifically scoped out of the Ind AS 116 and being dealt as per the requirement of Ind AS 38.
Okay.
I hope I could clarify all the questions.
Yeah, in fact, thank you for taking such a big, large question and answering all aspects of it. Thank you very much. And very important point that Goodwill business combination is the standard which will actually talk about initial recognition of goodwill, and others would be covered under this particular standard. Yeah, that's something which is very relevant. Thank you so much. In fact, I had this particular, feeling sometimes when I'm thinking about intangible asset. Let's say, for example, if I buy a book and it's an ebook and it's a costly, expensive one, so I'm assuming it is material. Would that ebook, because it is not having a physical substance, would be classified as intangible, or it can be classified as an asset, assuming that it satisfies other conditions of the asset? And at the same point of time, what difference would it make if I classify it as intangible asset and not PP, and vice versa?
The second part was quite interesting. Sarthak and all friends, let me tell you, I think this particular question involves one important factor, that if, say, suppose there is a small tangible asset which is associated with an intangible. Say, for example, in case of an ebook, or let me elaborate that question a bit more. Say, suppose there is a pad which is given to you and that contains a lot of ebooks, a subscription, and that you can read on that. Now, the question is always that whether this particular iPad or the computer pad, whether that cost of pad would be a PP and the ebook intangible, or how do we do it? So broadly in intangible, the knowledge part or the research part or the input part is very much important. And thereby, we actually do not consider the other cost, that is the tangible part, as it is. Say, for example, in the artistic or like Mona Lisa painting or Mr. Hussein's painting, the canvas and that is not important. The important is the painting which has been done. So it has more of an artistic value rather than the physical value. So basically all these items, whether ebooks or this, even if they have a physical part, they would be part of intangibles only.
Okay.
And what is the difference if we take it for PP and then, so broadly, if say suppose, let me more generalize that particular part of the question. Like, say, suppose if we have an option, if an asset can be considered as PP and whether an asset can be considered as intangible, if we have an option, what will adopt it? Of course, PP is far more better because intangible asset have different conditions and other major issues attached to it, the disclosure requirement attached to it. So of course, PP is always better. But yes, it will not depend upon our liking, disliking, or option. It is basically on the condition. Yes.
Okay. Thank you so much. In fact, that helps so to understand. Now, getting on to the next aspect similar to this, like we talked about brands a little while ago. So if we are creating our own brands, let's say, for example, we are generating our own brand, or let's say, for example, our own logo. Is that something which can be recognized as an asset? Because we know self-generated goodwill cannot be recognized. But would the same principle apply to self-generated brands or not? And is the position under accounting standard, which will be relevant for partnership proprietorship, would be the same or would it be different?
Yeah, Sarthak. So Sarthak, as Rajkumar sir have already highlighted, that brand carry the same principle as for the internally generated goodwill. And standard is very specific that brands cannot be generated, cannot be self-generated, and cannot be recognized in the financials. When you move to the proprietorship and partnership firm, is the same principle applies to as we apply to the company. Even for the partnership firm or the proprietorship, brand cannot be recognized in the books. If that would not have been the case, and you would have seen the brand into the financials of big chartered accountant firms, and very apparent.
True.
That is not there in their financial, is not required or is not allowed to be recognized.
Okay. So brand also would be, if you purchased it from someone else, standalone basis would be eligible to be recognized as an intangible asset. But if it is something created by us on our own, then it will not be an intangible asset.
Yes.
Okay, perfect. Makes sense. Whether a customer list, like say, for example, I've acquired a company, and while acquiring this particular company, let's say there's an e-commerce company which is having 1 million customer base with it. I came to India and I thought that I'll rather acquire an existing company rather than an organic growth. So I acquired this particular existing company, which had this customer base in itself. Now, though this is more relating to business combination, but perspective of intangible asset to be added, can I recognize that customer base or the list of customers, the ready-made customers which are already there on that particular platform as a separate intangible asset or not?
Yeah. So basically, standard allow us to recognize the customer list which we are acquiring as a part of the business combination. Because it meets the separability criteria, identifiability criteria, you can basically, if standard allow, or I mean if you can basically establish that it is separable and can be leased out or rented out to some other entity for their own use, or similar thing is there, then you can recognize it in your financials as a customer list.
Okay.
On the contrary, if you have generated a customer list by your own, and that can also be having or meet the separability criteria, own generated customer list you can also list out, but standard specifically doesn't allow you to capitalize the same, because whatever cost you has incurred to generate the customer list is not distinguishable to the entire cost which you are incurring to generating the overall business. So if it is self generated, not required or not allowed to be capitalized. If it is arising from the business combination, then you can capitalize in the form of intangible asset.
Okay, excellent. So means if I have to recognize something like a customer loyalty because I have developed the customer base, I will usually not be able to, because the cost of incurring or developing that customer base cannot be distinguished from the cost of developing the business as a whole. Whereas if I acquire the customer list as a part of business combination or separately, I will be able to recognize that as an intangible asset. Am I correct? Right? Is that what you were trying? Okay, perfect. That helps further. Furthermore, let's say, for example, we understand that whenever we acquire asset, usually it will be for a cash consideration. So that is pretty straightforward in terms of what cost would be added. If in case we have acquired an asset, which is, let's say, under an exchange, which could usually be that I have exchanged certain licenses which I had with some other company and I have taken their licenses or some other intangible asset. So in that case, what are the principles with respect to recognizing the initial recognition of intangible asset? Similarly, what would happen if it is as a part of business combination? And in case if I have received any government grants on intangible assets. So once again, to kind of summarize the question, if I have acquired intangible assets with government grants under a business combination or under exchange, what initial recognition principles do I need to keep in mind?
Yeah. I think it needs a somewhat elaborate answer for all of you to understand. So I'm lucky that ICI has also given me opportunity to present in 1 or 2 class. So I have one slide, particularly on exchange. Why? Because the concept of exchange is sometimes very confusing. So let me put one slide to all of you. Is my slide visible?
Yes, sir.
Okay. So if you see the slide, basically, so now what exactly it is? Now say suppose the question is, to understand the question, say suppose a particular movie right is taken and another some broadcasting right is given from one company to other. That is, I'm exchanging my one asset to another asset. The concept of exchange is similar in India 16 as well as 38. So we can understand it once for all. So broadly what happens is, if you give one asset and take another asset, and if there is no cash consideration involved, that means the value of the both on a negotiated basis would be the same. Now say suppose this exchange consideration can be with money or without money. So consideration together with money, either minus or plus, again, that would be the net value on which the exchange is being done. Now, interestingly, India has one more concept in it, which is called the commercial substance. Now, nobody would exchange their asset, particularly in business, if there is no commercial substance. By commercial substance, what we understand is that my cash flow would be changing, either positive, mostly positive, that my cash flow would have an impact if I change this. Say, for example, if I give a movie right, which I have for long period, but I need a broadcasting right for a particular region, which will give me more visibility. So therefore, I'm exchanging this. So because of this, there is a commercial consideration because my cash flow would change. Now, coming on to the accounting. So in this accounting, the question which arises is about the initial measurement of the asset acquired, right? So at what value will acquire the asset? So this table gives the answer. It says that the fair value can be determined and there is a commercial substance. Then the amount to be recognized as intangible is the fair value of the asset given. So whatever asset I have given, its fair value can be determined and there is a commercial substance. Then the fair value of the asset given is the value of the asset which I have to take, which I'll be taking. So what I'll do is I'm taking broadcasting rights, say suppose. So the broadcasting right initial recognition will be the fair value of the asset given. And on the credit side, whatever asset you are given, that will be written off, and any difference, surprisingly or beneficially, it goes to the profit and loss account credit side. So you make a profit out of it. There is one remark which is given that fair value of asset is more reliable. So in case of fair value, it is the reliability ladder actually which we climb, as we have seen in India. So if the fair value of the asset taken is more reliable, then we opt that fair value. Otherwise, the asset given is the basis. So the first line is the important thing. In all other cases where either the fair value cannot be determined or there is no commercial substance, basically what we do is we account for the incoming asset at the carrying value of the asset given up. So basically there would not be a difference until and unless if there is some cash component involved in the exchange transaction. So Sarthak, am I clear? I'm not sure.
Yes,
I was in my flow. So
No, absolutely, sir. I mean, perfectly mentioned. So I will just kind of summarize it. You please tell me in case if I missed anything.
Yeah.
So what you mentioned is that if there is an exchange, I am, let's say, giving movie rights and acquiring broadcasting rights, then the fair value of the movie rights which I am giving, that is essentially my cost. I'm going with the cost principle. So this is what I've incurred. This is the opportunity cost to me. So the fair value of the asset which I've given will be the carrying amount of the broadcasting right which I have acquired. Unless and until the fair value of the broadcasting right which I have acquired is more clearly evident, which would not usually be the case, but in case if the transaction has so, then I would prefer using this fair value. In all these cases, if the fair value is not evident at all, in that particular case, I will simply recognize the new asset at the same carrying amount of the old asset. In this case, there will be no profit or loss. In the earlier cases, there would be a profit or loss which would get debited or credited to the profit or loss account.
Broadly.
Okay.
And to add it, in all other cases, whether there is a commercial substance or not. So either the fair value can be determined, cannot be determined, or whether there is a commercial. So the different cases, so both should be there.
Sure. So commercial substance has to be there if at all we have to do this. Otherwise, it will just be recognized at the carrying amount. So it will just be a nomenclature change.
Yeah.
Right, sir.
So I have another part to it. So exchange of asset as there in one of this. So you had two.
Sorry to interrupt,
points.
sir. Sir, can you please put it on the slideshow mode? Some text is clipping.
Okay.
The presentation, if it is comfortable, otherwise.
No problem. Is it now?
Yes, sir. Perfect.
Yeah. So I think in one of the line exchange of the asset, the third row from above, we discussed. So you also asked what would happen in business combination.
Right, sir.
Basically, and the government grant. So let us see first the government grant, acquisition by way of government grant. So in this case, what happens is, in case of government grant, we have two options. Either we can fair value the intangibles and accordingly recognize it, or we can do it at a nominal value. Say, suppose we have been given a license, and if this license can be fair valued, then we can account it at fair value or at a nominal value. So this is one of the way for accounting acquisition by way of a government grant. Now, business combination is very important. I like to take a minute on this. And perhaps this is also a problem when I discuss with many of the professionals. So basically, how business combination, intangible, and goodwill, basically this question of goodwill will also come in impairment later on when we discuss. So let us give 1 minute to business combination. So business combination, basically what happens is you acquire a company. Now say suppose I have acquired an education company at say suppose 5 lakh rupees. Okay. Now, when I take all the asset in the education company, like computers or table, chairs, office, and all this thing, it may not be more than 1 lakh rupees. The question is, what is this additional 4 lakh which I have paid for? In our earlier times, what we would use to say that was, this 4 lakh difference is basically the goodwill that you have paid. Now, the index goes one step forward. The index says that you have to identify the other intangibles that you are acquiring. So at the time of business combination, when we acquire an entity, what we do is we do a purchase price allocation. Based on that, we identify what are the tangible asset, net current asset and liability. Then we start identifying whether we have, like say, suppose if you ask an entrepreneur why you have purchased this new entity, he'll tell that because it has this, and this. And over and above, they were asking for 1 lakh more, so I've given 1 lakh more. So I have given 5 lakh, 3 lakh for the brand which has, and 1 lakh for goodwill. So basically what we do is, we, in this business combination, over and above the tangible asset, we try to identify if we have acquired any other intangibles. Those intangibles are fair valued and accounted for, and balance goes to goodwill. So in case of an education company, out of 5 lakh, if 1 lakh is tangible, we identify that we have given 3 lakh, fair value 3 lakh for the brand, then we account 3 lakh for the brand, and the balance 1 lakh goes to goodwill. So these are the 3 ways in which exchange, business combination, and government grants are accounted for.
Okay. Great, excellent. So which essentially now means that we can say that in business combination, intangible assets, initial recognition would be at fair value, except goodwill, which will be a balancing figure. Hence, it would be recognized at cost.
The important thing, Sarthak, in this is that we identify whether we have acquired intangibles. Are there any intangibles due in a particular business combination? That is where the difference is actually.
Okay. Okay. And sir, in accounting standard also, it will be similar in terms of the same process would be followed? Particularly with respect to brands, if we talk about like.
Not exactly. It used to go to the until and unless it was specifically identifiable.
Okay.
But broadly, see, with India's, what has happened is it has clarified many more things, and those are specifically there.
True.
That is the major difference. But in case if you have acquired intangible, of course, we can do it in AS as well. Adesh, you have any other view on this?
Yeah, you are right, sir.
Okay.
Yes, sir. That's correct, sir. In fact, because, India's, yes, clarifies a lot of things. Accounting standard are not so elaborate in that sense. So we have specific.
That's the only difference, yes.
Correct. Government grant, on a lighter note, sir, you used the example of airport rights under government grant. Any particular specific reason for it?
See, this is one of the hot topics. So yes, when nothing is taken, so therefore the airport right, either you can fair value it or you can put it at.
True. I was just generally curious, so just asked about it. Right?
Yes.
So my next question is that we were talking about, so coming on to the cost, this was more in terms of the purchased or acquisition side of it. Now, if we talk about the self-generated side of it, wherein we are ourselves constructing an intangible asset, let's say, for example, we are developing our own ERP system or a software, or maybe a website for purpose of sale, which we will try to recognize as an asset. So in this, just need to understand the standard talks about the research phase and the development phase. So therein, what do we mean by a research phase? And more precisely, when do we say that these expenditures now qualify to be of the development phase? And accordingly, what is the accounting treatment under both these phases?
Yeah, yes, Arthur. So basically, standard categorize R&D into research and development phase. Expenditure, whatever, let me set the context. Expenditure, when entity is incurring into the research phase, is being charged to the profit and loss.
Okay.
And once expenditure is being done into the development stage, and entities meeting or can demonstrate certain parameters can capitalize those expenditures. Otherwise, those will be charged to PL. And to start with, what is the research phase? When entities kind of let's say entities trying to develop a software, entities into the investigation mode, evaluating lot of options, evaluating lot of available, try to gain new knowledge or try to create a prototype, and evaluating, you can say, different type of possibilities. So those phases when entity is not certain whether any intangible assets will be created out of the research which they are doing or not. So once entity is kind of done with the research phase and some kind of a prototype is with them, and when they start implementing the outcome of the research into the development, when you can say the development stage starts. And once the development stage starts, then if you can demonstrate few items or the few parameters that, for example, that intangible assets will be created, you have a technical feasibility that intangible assets will be created, you have adequate resources available, be it financial, be it technical, and you can demonstrate that how future economic benefit will be derived out of the intangible assets which you are creating. And you can also say that expenditure which you are incurring is reliable or can be measured reliably. You can identify those expenditure as a separable thing, and entity has the ability to generate or has the ability to sell those intangible assets. If these parameters are there, then you can say the expenditure which you are incurring into the development stage can be capitalized, otherwise will be charged to profit and loss.
Okay. So can you share some examples of development phase expenditure to kind of further relate better to it? Let's say, for example, if I take the software example itself, so what kind of cost would be part of development phase and hence eligible to be capitalized?
Yeah, as I mean, you rightly pointed out, there was one question also in the case of the cost which entity is incurring in the implementation of ERP. Let's say entity is self-generating an accounting software for their internal purpose, and entity is done with the prototyping, and those cost for example, I mean, any salary of a related staff which is involved over there, or any direct material which you are investing into those activity, those things you can say are directly attributable and you can capitalize. Then there can be other expenses which are not directly attributable, but you can relate to those. For example, into the development phase, you are using one of the floor of office premises. So depreciation of one of that floor you can capitalize. And then there can be other expenditure which someone can say are generalized in nature, general administrative expenses or expenses which you are incurring in the training of a staff when staff will be using that software, or expenses you are incurring in the advertising of the software if you are trying to basically kind of lease out to the market and all. So these kind of expenditure are the ones which you charge to the people.
Okay. And during this stage, if I've paid in advance to, let's say, for example, a contractor who's giving me some service which is helping me in development, would that advance be classifiable as an advance or a part of the capital work in progress or intangible under development head?
So Sarthak, advance paid under the when you have intangible asset which is into the development phase and you paid any advance, that advance will be specifically parked as a capital advance and will not be capitalized as a part of intangible assets under development. So this is a common error which we see in a lot of financials, where entities capitalize the advance paid if any asset is under development stage to the intangible assets, which is not a right thing. You should basically park it to the capital advance.
Okay. That is insightful. Thank you so much for that. I think these are mostly in terms of intangibles, more relevant questions, which could be relevant for a lot of them. Coming on to the disclosure side, I wanted to check, understand Schedule 3 had certain new amendments, in fact, 2021, so not real, very new, but yes, there were some new disclosure requirements which were popped up in that. So any specific thing which you would like to highlight with respect to particularly the new disclosure requirements of Schedule 3 relating to intangibles?
Yeah. So basically, there are new requirements. One is in respect of revaluation of an intangible assets.
Okay.
So if entity is revaluing an intangible assets, revaluation should be as per the registered valuer. This is a specific requirement. And in case if the revaluation is more than 10% of the carrying value of an asset, more than or less than, if change is more than 10%, the entity should specifically disclose the same into their financials. Apart from that, if entity also has some intangible assets which are into the development phase, intangible assets under development, then entity basically need to disclose the project which are into the development, and will also provide the aging of the same. Entity will also need to disclose if any intangible assets has been suspended for a while. So development is not being done now, and for the timing it has been suspended. And for the entity are also required to disclose wherein the cost of development, initial planned cost of development has been exceeded. So these are the things which entity need to disclose apart from the fair valuation.
Okay. So you mentioned about disclosing about revaluation. So that brings us to another important aspect. One, intangible assets under Ind AS, can it be revalued? Second, is the position same under accounting standard? And there is a concept of some active market price required for purpose of revaluation in intangibles, unlike in PP. So a little enlightenment on that.
Okay. So basically, Ind AS allow us both the approaches. You can also follow the cost model, or you can also follow the revaluation model. While under AS, only cost model is allowed. So you cannot follow the revaluation model under the AS regime. And when active market is not available for you to basically recognize the asset at a fair value under Ind AS, then you can use the carrying amount of the same to recognize.
Okay. Rajkumar sir, anything you would like to add on this? Sir, you will have to unmute, please.
So I'd like to bring one important thing here is revaluation. First, we are very hard-coded for the historical cost method in accounting. So wherever we see it is historical cost, but we have to understand that Ind AS is basically a very dynamic accounting where the balance sheet should show it at basically a recoverable sort of value of the entire business per se. That is the underlying thought process somehow. So the important difference is whether we have to understand that Ind AS 16 as well as 38, PP as well as intangible, both give you option of revaluation. So either you can carry your asset at cost or you can carry it at revalued. Now, particularly in intangible, as we know that valuation is not easier and it is normally simpler in PP. So in Ind AS, they have given a rider which says that revaluation would only be applicable in case of intangibles if you have an active market. So if you are able to sell your intangible in active market, then you can revalue. Otherwise, you cannot revalue, then you have to take it on the cost basis only. So this is the important departure and important difference between revaluation concept of PP as well as intangible. So this is I wanted to add.
Okay. So I think that's very intelligent thing to mention, because otherwise assets like brand also would have been revalued.
Yes.
You can then, value it at any particular value, because
Yes.
there's a huge amount of subjectivity.
Yes.
Coming on to the next important aspect of intangibles, amortization. So one, whether we need to definitely amortize all intangible assets under Ind AS, and when should an amortization begin and when should it cease?
Yeah. So yes, this is a very basic question, and this particular we all tumble it every now and then. that when should the amortization or the depreciation begin and how and what is the point. So we have to be remember it in inverted comma when the asset is available to use as intended by the management, basically. So as and when the asset is asset is available to use, that is the time when we start amortization or depreciation. Now, when do we have to cease? So we have to see that the seizure of depreciation is only when it is either retired from active use, or it is put off and not, or it is transferred to asset held for sale. Basically, these are the only two, or sold, basically retired from active use and sold, or well. But if you are not using it, still kept ready for use is also depreciable. So we have to remember this. The cessation happens only when you ultimately say that it is not useful and it is a scrap and I'm getting it for sale. Till then, even if you're not sale, then still the depreciation would be or amortization would be going on.
Okay. And sir, any intangible assets, like, is it compulsory to amortize all intangible assets?
Okay. Now, this is again a very, very important thought process and a very important concept that whether all assets have to be amortized. So basically, the India says that the concept of amortization is you have to divide the asset between two. One is asset with an useful life, which is definite, and asset which their useful life is indefinite. Asset with a definitive useful life is amortized over a period of their useful life, and indefinite useful life, those assets are not amortized, but they are tested for impairment. This is the basic concept we have to remember, and it is a bit departure from normally the concept which we normally see or have been hearing over a period of time.
Okay, so indefinite life assets will not be amortized altogether.
It will be tested for impairment. Its value should not reduce.
Okay, understood. So you just check it for impairment, but there is no ongoing basis of amortization which happen years on.
Right.
Okay. And so this is similar to what goodwill would be in case of business combination.
Exactly.
Okay. And is there any method prescribed here, like an SLM or a WDV or specific life-based or usage-based method for intangibles?
Yes, of course, all the three methods which are there in PP, that is the straight line method or those things, all the three methods are prescribed. The unit of cost method, as we say, is the production number of units which are produced, and that can be the basis. But we have to always remember that one of the bases which is considered as revenue. Like, say, for example, if I generate X revenue, then I would depreciate or amortize up to this level, is not recognized by Indians. Otherwise, all the three methods are recognized. The third method is called as unit of production method. Right, Adesh?
Yes, sir.
Anything you'd like to add on this?
Yeah.
So I'm not elaborating on the methods because we have been reading always. So, but so the name of the third one is very different.
So basically, amortization should reflect the way you basically consume the economic benefit. As it's rightly said, there are three methods. One is straight line, one is WDV, and one is unit of production method. These three methods are allowed, which can be used to amortize intangibles.
Okay. And if we talk about under income tax, I remember like there was a recent update or amendment also which was done that goodwill amortization was not permitted under income tax. That amendment was done a couple of years ago. So a little bit on that regards as to the provision of income tax with respect to depreciation on intangibles and also goodwill.
So let me first give the smaller part. The smaller part is basically amortization, particularly. So as far as the amortization is there, we have the concept of amortizing over useful life. That is for accounting purpose. As far as the amortization or the allowable depreciation for income tax, we have a schedule, And there you have the mentioning of in the part B that 25% of the intangibles can be allowed as deduction. The difference would be part of the deferred asset, deferred asset or deferred liability, as the case may be. Plus, there is one more reflection: computer and software, when all put together, there is a different schedule which carries depreciation of 40%. So any software brought together with the computer, it is depreciated at 40%. So these are the two items in the entire schedule which is there as far as the income tax is considered. Now coming on to the goodwill deduction in income tax. Okay, so let me clarify once and for all. What was the matter, how it came to income tax, what is the fallout, what has been the practice, and what is going to be the practice. So let me tell you, internally generated goodwill was neither allowed in our AS, neither it is allowed in Ind AS, neither it was allowed as a deduction in income tax whatsoever, or even the deduction in income tax was not allowed. But what happened is, like, say, suppose if you acquire certain particular, if say, suppose there is a business combination or there is an amalgamation either between the group company or when it is acquired, certainly there is a Supreme Court cases where it says that goodwill is also an asset and it can be amortized. So there was a particular Supreme Court case based on which, whenever there was amalgamation or particularly within the group also, like say for example, like if one of the subsidiary and other companies in the group are merging together, there was sometimes goodwill generated. I would not go into the detail. And that goodwill, based on one particular Supreme Court cases, many of the professional and groups were taking it as a deductible expenses. And since it was Supreme Court case, it was allowed. This came to the government, and I think in last financial budget or pre-financial budget, it has been specifically told that goodwill on amalgamation would not be allowable as deductible tax expense. So now that leeway is not there.
Okay. Perfectly fine. That helps a lot because I mean, this is very clear. So income tax, we just have two items. One is for computers, one is for other intangible, 40% and 25%. Whereas under Ind AS and AS, we use our own useful lives for the purpose of amortization. I also remember accounting standard used to have this notion that you cannot have an indefinite life there. So usually you used to use a thumb rule of 10 years of life unless you have a reputable presumption to prove, which is not the case in Ind AS, where we can still have indefinite life, where will there be no amortization, but we will have to test it for impairment every year.
Yeah. Sarthak, I think what I missed, you pointed out rightly. So in AS, I think it needs half a minute, not half a minute, 10 seconds for that. That particularly in AS, there was a concept that there would not be indefinite life, and the maximum life an intangible can have is 10 years. So that was the concept there. This concept is not there in AS.
Right. Fair enough. So, we've kind of covered a decent bit on intangibles. I'll move on to impairment. Just a couple
before that, I think you should take the questions. Let's take the question.
Fair enough. Okay, right. I just have one.
Sure. मेरे ख्याल से तो it would be better that we take the questions of the public together.
Okay.
At the end.
Otherwise, something in the impairment could be missed.
Okay. Yes, sir.
Okay. So we have a note of all the questions. We'll keep it at the end. So I'll continue with my discussion on with respect to this. So coming on now to impairment, just before that, one last small question on intangible. In case we take the life, question number one, the life should be based on the legal life or the economic life. And second, in case if there are any change in estimates, whether it is with respect to life, residual value, or even the method of depreciation, should it be accounted for prospectively or retrospectively?
Very nice question. Again, it is a departure what we are hard-coded. So all these three things are taken as estimates because these are only estimates. So all these are not a policy changes. These are estimated changes and they would be prospective.
Okay.
They would be prospective.
Okay.
So friends, remember, any change in useful life, any change in depreciation or amortization method, these are not policy changes. These are estimate changes.
Right. So those age-old practices of SLM to WDV, which used to be retrospective, are no more there. It is all change in estimate and prospectively accounted.
Yes.
Yeah. And starting to question to basically
Yeah.
answer the second part of your question. So basically, we should amortize over the economic life. So because over the economic life, entity is going to generate the economic benefit, so asset should be amortized over the economic life of the asset.
Okay. So if I have, let's say, a stock membership broker license, which is indefinite life, I mean, till the company exists, that license is valid. But I feel that the economic life, I will only be able to generate benefits for next 30 years. So I should be using 30 years as the life of the asset.
You're right. You should amortize it over a period of 30 years.
Okay. Perfectly fine. In fact, thank you so much. A lot of intangibles, intangible otherwise, because you don't have a physical substance. So it's a very gray area. But I think we got a lot of insights. Thank you very much. And the next one is impairment. So impairment is another, one tough standard really to apply on the ground. Because once you start applying this standard, it has huge amount of subjectivity in terms of computation and all. But I'm sure that this session will help us to, take out those, correct those common wrong notions in case if there are any. Starting first with the first very question, what are the AS, IND-AS and ICDS with respect to impairment?
Yeah, I'll briefly describe. So friends, IND-AS 36 is for impairment. The equivalent AS is 28. Okay, there is no specific ICDS for this. But what we have to remember is very different. Impairment word is used in many standards. And the provision and thought process for other assets and many different assets are given in those standards only. Say, for example, for financial asset, it is 109. Any impairment of financial asset would go to 109. Say, for example, when we are testing inventory for NRV, basically that is impairment testing only. But the provisions or the requirement of how to test and why to test and when to test is given in IND-AS 2. So therefore, IND-AS 2 is applicable for inventory. When we are doing this gratuity employees benefit, basically, if there is a fall in value of planned asset or something like that, again, that testing is given at that particular point of that particular place. I would just only reflect one particular IND-AS, that is 105. 105 is asset held for sale. Now, the asset held for sale are to be accounted for as the carrying amount or fair value, whichever is less. Now, carrying value carrying amount or fair value, whichever is less, means you have accounted for the impairment basically. So the impairment is given in that standard indirectly by way of valuation. So friends, do remember this impairment is for particular type of asset, but there are other IND-AS which have their respective write down of the asset based on the different category of valuations.
Okay. That is very insightful, sir. I really appreciate the kind of connectivity you create with all the different standards. So it is really appreciable. Thank you so much for that insight. So if I talk about specifically IND-AS 36, what do we mean by impairment under IND-AS 36 and AS 28 versus IND-AS 36? Is there any difference?
Yeah. So basically, when we do say what is mean by impairment, we assess for the impairment when we believe the carrying value of an asset is lower than the recoverable amount, or is higher than the recoverable amount. When we believe that asset is carrying at a higher value and the entity will be recovering a lesser amount, then we basically recognize the impairment loss in the financials. And principally, it is similar to the AS 28. Principally, they are the same in terms of the recoverable amount. When we do see recoverable amount, it has two places: value in use and the fair value. These all principles are there under AS 28. There are some gap differences. For example, if I do call from the scope perspective, the impairment of subsidiary, JV, and associate is specifically covered the IND-AS 36, while this is not part of the impairment under the AS regime. And on the other hand, impairment of a goodwill. In the case of IND-AS 36, we do test for impairment of goodwill every year, irrespective of the indicators. While under AS regime, we do test for the impairment of goodwill when there are indicators. And then one difference is on the reversal of impairment of goodwill. Under the In this scenario, we never reverse impairment of goodwill, while under AS regime, in very exceptional circumstances, when you have recognized the impairment of a goodwill because there was some external, very specific external indicator, and now you believe that external indicator is not there or has reversed or not likely to reoccur again, then in that very specific case, you can reverse the impairment loss of a goodwill under AS regime. While under AS, in AS, it is not allowed at all.
Okay.
So these are the major differences between AS and
Okay.
AS.
Okay, brilliant. So that means the principle remains the same, but there are some nicer differences here.
Yeah.
So what I understand with, what you both of you explained, one, in AS 36 impairment is when the recoverable amount, what we'll be able to recover, if we just take the literal meaning of it, is lesser than the carrying amount at which we are carrying that particular asset, mostly the cost of the asset in the books after depreciation. If that is lesser, then we have an impairment. If we take the exceptions, or let's say the other Ind AS which talks about impairment, like the financial assets or plan assets, Ind AS 19 employee benefits, or Ind AS 2 inventory, even in those cases, we are talking about the fact that an asset is recognized at a value and we feel that there is a deterioration in that particular value. Then in that case, that deterioration in the value is recognized as an impairment. So literally, impairment would mean that there is a deterioration in the asset and there is a loss of value, because of which we have to recognize the loss. So my very imperative, very important question is that, can I say that an asset, if it is carried at fair value, which means under the Ind AS, the principle of valuation is fair valuation used, let's say revaluation model for a PP, can I say it is not required to be tested for impairment at all?
So Sarthak, in a way, I mean, if any asset is carried at fair value, for example, let's take an example of biological asset. Biological assets as per Ind AS 41 are required to be measured at fair value. Once we measure it as at fair value, fair value in itself represents the recoverable amount of that particular asset. So in a way, it is impaired. Fair value can be higher or can be lower. When fair value is lower than the previous reporting period, then you can say it's kind of representing an impairment loss, which you are recognizing in the form of a fair valuation gain or loss.
Okay. Okay. So basically what I understand is that fair valuation and impairment are two independent concepts. Usually when we'll use a fair valuation approach, in most of the cases, impairment conditions may not, or that testing may not be required altogether. However, still both of these standards would remain and would be executed independently.
Yes.
Right. Okay. So what is the difference between revaluation and impairment if I use the definitions given under the respective standard? How do I compare, and are there any nicer or smaller differences between the two?
So Sarthak, basically there's not, so this is, I think, in addition to our just last discussion on the last question. So basically we have to understand two things. One is the impairment and other thing is fair valuation. So if I put it in Venn diagram, so impairment is a larger ball or larger circle and fair valuation is only a smaller circle. The concept which we have to understand is, say suppose you bring a car, maybe to drive it as a taxi or maybe as an asset to your PP. Basically, you bring it for a particular purpose that is used for the business. Now, when we purchase a particular PP, we understand that the value of the asset I'll be able to realize over a period of time, right? So basically, the word which is called value in use is important. Value in use, that means it is the present value of the future cash flow that I'll be able to generate, right? So say suppose I have brought a car, I run it for taxi, and if I bring it for 5 lakh, okay, then what a person says that I'll drive, मैं इतने दिन में इतना ड्राइव कर लूंगा, रोज मुझे इतना सवारी मिलेगा, इतना पैसा लगेगा, इतना पेट्रोल होगा, इतना गैस होगा. So I'll earn this much in 1 month and multiply by 8 months or multiply by 8 years or 6 years, what the case may be. This is the revenue what I'll generate. So we have to understand that in normal business, we don't bring asset for sale at fair value. We bring asset for use for generating cash flow. Based on this concept, now let us understand what is the difference between impairment and fair value. So fair value is only one part of the impairment testing. For impairment testing, what we do is first we see what is the carrying amount or carrying value. This is as per the balance sheet. Second, what we see is we see what is the fair value of the asset. Whether I have to, whether if I can sell it in the open market, what could be the fair value. Third, what I do is why I have brought this asset for use. So what will be my value in use? That is the present value, net present value of the cash flow, future cash flow that would be generated. When I compare now, what will be my recoverable value? That is the fourth part. Recoverable value is how I can recover my asset value. Either I sell it in the market or use in business. Use in business is value in use and sale in the market is fair value. So higher of this, I'll be using it. If my taxi cannot be run, then I'll sell it in the open market. So higher of value in use or fair value is the recoverable amount. Now, what is impairment? Impairment is I am carrying a particular amount in the balance sheet, but my recoverable amount is only less or iota less. That means that is the delta which can be called as an impairment. So coming to the question, valuation, impairment and fair value is entirely different. Fair valuation is a part and parcel of the impairment testing. That is what it is.
Okay. And here, sir, when we talk about an Ind AS 36 impairment, the fair value or the value in use, whichever is higher is the recoverable amount. Here, the fair value would be the net fair value, which will be the net of the selling cost.
Cost of disposal.
Disposal cost.
Cost of disposal.
Right.
Yes.
So that would create one small difference because when we use revaluation, there we would use the selling price and not the net selling price. And here it will be net of the disposal cost.
Yes, you are right.
A very small difference.
Yes.
But
yes.
in terms of the terminology. Okay.
Yeah.
So here, as in, because now since we've said that we are checking PP for impairment or intangible assets or any such assets, is it something which is to be tested every year? Because it will become a big task for any particular company to calculate the value in use for an asset because that's not readily available. You have to estimate in terms of what an asset would be earning. So is impairment testing required every year or what are the conditions for testing impairment?
Adish, maybe you would be taking this?
Yeah. So, Sarthak, we do test for the impairment when there are indicators. There are exceptions. There are 3 assets. So let me broadly mention. So we do test for the impairment when there are indicators. If indicators are there, we do basically calculate the recoverable amount and recognize if there is an impairment, then we recognize the impairment loss. Only in the case of indicator. However, if we have 3 type of asset, one is goodwill, one is intangible assets under development, and one is intangible assets having indefinite useful life. If these 3 assets are there, then irrespective of the indicator, even if though indicators are not there, we do test for the impairment on an annual basis. Or whenever the indicator arises, there may be situation then we do test for the impairment twice a year. I mean, one at the regular time and one once when the indicators are there. So if we have these 3 type of asset, we do test annually. Otherwise, we do test whenever there are indicators for impairment.
Okay. So when you're saying about indicators, let's say, for example, I've acquired an asset, let's say a vehicle, a car. And after my acquisition, suddenly there were some changes in the BS norms, because of which my car sellability has reduced and hence its market value is significantly declined. Can this also be regarded as an indicator? Question specifically asked in the context because my intention was never to sell the car, but to use it in my business. Let's say I'm running taxi or earning revenue out of it. Still, would it be treated as an impairment indicator as per the Ind AS?
I mean, the indicator which you mentioned is a significant decline in the value of asset is basically mentioned is an external, one of the external indicator provided by the standard. There are other external indicators, for example, a change in the technology or change in the market capitalization, a reduction in the market capitalization is the right word. And they, on the contrary, there are internal indicators also when asset is idle or asset has been damaged. These kind of scenarios there. When there is a significant decline in the value of asset, it represents that value of asset is lower than the carrying amount, which you can see in the recent case of a Silicon Valley Bank, where they were holding lot of assets, which was having a lower value than the carrying amount, though those assets were of a financial setting nature, but apply the same principle over there. Entity was carrying those assets at a in the books at a carrying value, while fair value of those assets were at a lower amount, because entity have to monetize those today, so they have to recognize a significant loss in the financials, and this collapse happens.
Okay, got it. So that means the Ind AS gives some illustrative factors, external and internal. If those are present, these are indicators. And obviously, when we do the impairment check, it could so happen that there is an impairment and there may still not be an impairment, even if there are indicators for it.
Yes.
So when we have to check impairment, the terms which we were discussing, carrying amount, value in use, net selling price or the fair value less cost of disposal, and the recoverable amount, can you show, in fact, can you tell us, enlighten us a little more light on these terms in terms of certain things to keep in mind while calculating these things?
Yeah. So when I say recoverable amount carries two P's, one is value in use and one is fair value less cost of sale. When I say value in use, is basically represent the value of a business. If entity will continue the business for a period of time. Let's say if you are evaluating a value of a business, then when you are calculating, basically it represents a discounted cash flow. Then you need to keep a lot of things in the mind, that the projections which you are used are for a reasonable period. It's not that you are going beyond a certain defined period by the standard, and what discount rate you are using, what growth rate you are using. When we, for example, if you are calculating the fair value of a business, and business, you cannot say that it will be there for a period of 5 years or 10 years. Generally, you presume that it will be there for an indefinite period of time. So you consider initial 5 years, and then you also calculate a terminal value. So what all assumptions you are considering when calculating the terminal value, what all growth factor you have considered, these all things you need to keep in mind when you are calculating the value of a business as a whole. And on the contrary, I mean, the value of a business as a whole, how to be done, the fair value of a fair value as per the value in use, I would say, is defined under the Ind AS 36 standard itself. While if you are calculating the fair value less cost of sale, fair value represent the amount which you will be getting when you will be exiting the market, and you apply the principle of Ind AS 113 fair value measurement when you are calculating the fair value of fair value as per fair value less cost of sales. So these are the basic things you should keep in mind. Fair valuation can be done by a different approach, market approach, in this case, a replaceable cost approach, which you can follow to recognize this.
Okay. So I understand in these terms, carrying amount is pretty straightforward because after depreciation, you get it from the books. So is fair value, not straightforward, but it is purely one factor which you have to build from the market. The most calculative or subjective term possibly would be value in use. Now, when I have to calculate a value in use, which is present value of the future cash flows, as you mentioned, when this for an individual asset, let's say, for example, if I'm running taxis on hire, I know that this will be earning X amount. But it could so happen that, sometimes, like say a hotel, individually, the building or the furniture or the fixture or the equipment may not earn cash flows on themselves. So in such scenario where not every asset is helping me to generate cash flows, but there is only a group of assets which together can generate cash flows, how do I do impairment testing? Very specifically asking about what is the concept of cash generating unit in this particular case, to start with the first part of it.
Right. Sarthak, I should actually congratulate you on the way you ask questions. So your question was at the end, and so that built up of the question, I really, and it will give a thought to all the listeners as well to arrive at that particular part. Good. So friends, basically, let us understand what CGU is. It stands for cash generating unit. Basically, for impairment, we have to see whether whether our value in use of the business, whether as a business as a whole, will be able to drive. The standard starts from impairment testing of the individual asset. So the the standard says that basically the value in use of a particular asset should be tested. Now, if a particular asset, say suppose in case of hotel, only the hotel building or the part of hotel building cannot be a cash generating unit because it may not be able to specifically generate cash. So the question is, at what level and what is CGU and how it would be constituted? So there is a small definition and a small concept. CGU is a aggregation of asset that can generate revenue largely independent of the other asset. Let me repeat it. So individual asset do not generate revenue. What we do for impairment testing is we start aggregating the asset. The level of asset which can generate revenue at their own level would be a CGU. If they cannot generate of their own, they have to have other asset to including that asset. So the level when they are able to generate their own as cash flows, that is a CGU. Say for example, a product line. If there are 10 products line and one particular product line can itself generate revenue, a product line can be a CGU. A business individual location. Say suppose there are 2 factories of a particular company, then each factory can be a
cash generating
can be a CGU. Okay. Then there is another way how the management takes decision about purchase and sale or amalgamation or hyphing of the particular business. So that particular would also give an indication. Sometimes indirectly, though it is not mentioned, but practically segments also in itself give an indication of the CGUs. What is specifically given in the standard is if a particular byproduct or a product at a particular stage is sellable in the market, then that particular product or sellability would make it as a CGU itself. So these are some part of the CGU. Say for example, now take an example of a hotel and how practically it happens is. So friends, basically, when we are doing this aggregation of asset, we reach to the top level of the company. Basically, it is business as a whole. Practically, the business as a whole is valued as a cash generating unit until and unless a particular group has 10 type of business which can be individually valued. So these aggregation of asset basically comes at the business level. As for example, in hotel, the hotel in itself, neither the building can generate, neither the fixed asset can generate, neither the swimming pool can individually generate. When they all come and put together, when the generation is there, that is what you call CG. So that is the concept.
Okay. So like in case of an airline, let's say, for example, I have 10 aircrafts in my fleet. All of them are running on different routes. Maybe a couple of them are on the same route. Can I consider every individual aircraft as a separate CGU, or would it be 10 together as one CGU?
So this is one of the example which is highly prevalent, and a combination of this question is normally prevalent in India's examples also. So it's a very, very interesting example. So broadly, we have to understand one very important thing, that in airline, it is not only the aircraft which is important, it is the license of the routes that are important. Say suppose if you have to fly, if you have to have an airline, then you have to minimum have these much of the routes that you should be able to fly. Or you have to make minimum, say suppose if you have a Delhi-Bombay, then you have to do at least 2 routes, or you'll be given a particular this thing. So broadly, until and unless we are able to fly on all those routes, it will not be worthwhile, and neither it can be done. So therefore, ideally in cases of bus, airline, it is not the aircraft which generates revenue, it is the airline itself which is actually a system and a CGU. Though in a particular case, if it is a standalone as an exception, it can be evaluated, but it may depend upon circumstances. But generally, even I've seen a lot of airline balance sheet also, it is done at the business level only.
Right. And in case of stores, if I talk about stores, like let's say we have these wholesale stores or stores where people go and buy products, which could be like, let's say, for example, D-Marts or the likes. There, let's say they are also selling something online and they also have a physical store. And these stores could be different stores in different cities. So for them, how do they classify CGU? Would it be each store one CGU? And what about the online business?
See, we have to understand one more small concept that together with the impairment, the daily, whether the day-to-day repair, maintenance, and realizability, those are different. Basically, impairment is whether I'll be able to realize the value over a period of time. Even in these cases, a store can be evaluated. A particular standalone store can be evaluated whether it is making sales or not. So if the sales are not there, the entrepreneur would stop that stores because it would not be generating profit. So the same concept is there basically. Broadly, if it is one store only that is making, but let me tell you, Sarthak, that is not the intention of Index 36. Index 36 is far more bit on a higher place. Though it says the asset testing should be there, but basically it is the business concept broadly of online or offline business. Broadly, it would be at a business level only. Practically, that is the best possible. But yes, on a particular basis, a store depending upon. But from an accounting point of view, if a particular person does not want to say suppose stop the stores even if it is making a loss, so the auditor cannot question it.
Okay.
Say suppose if there are 20
True.
stores and one is making loss,
True.
Mr. Deemat Dabani sir would tell that I have opened it for my namesake. It may not, other 10 stores are making
True.
profit. So I have to see the business as a whole. For me, it is a segment.
I agree, sir. In fact, excellent example because so it is more so in terms of collectively they see. So it will be very much on the management side. So auditor will have its hands folded. He'll really not be able to question.
No, not exactly. Not
Sure.
exactly. It would not be hand folded. But broadly, the impairment testing is almost like, say, for example, Tata did a write-off of 1,400 crore for its entire vehicle and passenger vehicle and entire company level. No, that had passenger also. Those are so they had taken a company as a whole. They
Sure.
didn't do it for passenger or commercial vehicles separately. They did at a business level.
I agree, sir. In fact, a lot of brands would be having stores in a lot of malls which may not be earning profit, but for others' sake, other benefits, they would be running that. So it makes sense that it has to be seen collectively mostly at the business sense. Perfectly explained. Thank you so much for that. Next one, because we have now understood at the CGU level, the cash generating unit level. What about goodwill? Because goodwill in itself will not generate any recoverable amount on its own. It will be mostly helping the business to generate benefits. So how do we do impairment testing when it comes to goodwill? And whether goodwill has its own recoverable amount, and how do we calculate and allocate the loss with respect to goodwill there?
So Sarthak, basically we acquire goodwill as a business combination. So in a business combination, we acquired goodwill. So once we acquired goodwill, we basically allocate the acquired goodwill to the respective CGUs. Let me take an example. For example, let's say entity, I'm running an entity, and entity is in two different segments. Let's say entity is into the hospital segment and has 5 hospitals across the different cities, and also has, I'm also into the education business. That's it. And let's say, when I said I have 2 separate segments, one is hospital segment and one is education segment. Let's say I acquired a path lab, for example. So let's say I acquired a doctor path, for example. So this, and let's say just because of this acquisition, there is a goodwill arising. So once this goodwill is arising, I need to see to which business this goodwill is going to provide the synergies, which apparently would be the case of a hospitals. And let's say, as I mentioned, I have 5 hospitals. So let's assume that each hospital is a CGU. So in that particular case, whatever goodwill is arising just because of acquisition of a path lab, that goodwill I need to allocate to the respective CGU where synergies will arise, as in the case of a hospital. So I will allocate this goodwill to the respective 5 hospitals. I will not allocate anything to the education sector because there will not be any synergy because of this acquisition. So first of all, whenever we acquire a goodwill, we need to see in what business we are having a synergies and where we will basically utilizing these synergies and getting the benefit out of this goodwill. So in my case, we will be allocating the goodwill to these 5 CGUs, which are 5 different hospitals. And then whenever there are indicators for, as there are goodwill allocated to the respective CGU, we'll test for the impairment on an annual basis by the time we amortize this.
Okay. And in case if there is an impairment loss, would that be first allocated to goodwill?
Yes. So
Okay.
whenever there is an indicator, let's say CGU will be having in the case of the hospital business, CGU will be having a lot of assets, and goodwill is
Right.
one of those. So whenever
Right.
there is an impairment, first impairment loss will be allocated to the goodwill, and thereafter will be proportionately allocated to the remaining assets, which are covered under this standard.
Okay.
So Sarthak, if you lose
Here-
anything, first is because of the goodwill.
Right.
So goodwill goes. That's the concept.
No, here one of the actually we have got a very overwhelming response, more than 1,500 participants and more than 50 questions. One of the question, because we are discussing goodwill, one of the question which was asked by Sudeep Kumar Ghoshji is that, is goodwill amortization permissible for private companies? You know,
Yes.
this is why I'm
No,
asking this question specifically, because under income tax now it is not allowed.
Amortization is not allowed at all.
Under income tax. Under income tax not allowed, but as per the accounting standard, amortization of the goodwill has to be done. And as per the AS?
As per AS 14, we have to amortize it over a period of 3 to 5 years. But it is only in the accounting standard if it is arising under amalgamation. But again, under Ind AS, there is no amortization for goodwill. It is only tested for impairment.
So that's why for the private companies, there is hardly any difference. If whatever accounting standard is applicable, you have to accordingly do it. You have to accordingly do it. Just for the members at large, telling that it will again not come from the income tax.
Correct. Yeah. So, that clarification it should be there that for goodwill, the principle is very simple. Income tax for all entities now after the amendment, the goodwill is non-amortizable. For accounting under Ind AS, you just test it for impairment. You never amortize it over a period. Under accounting standard, again, if it is under amalgamation, then it will be amortized over a period. The panel, am I correct in terms of my conclusion?
Perfect. Perfectly articulated. So
Thank you, sir.
maybe Sarthak, we can take the questions, I suppose. Or sir, what you suggest, Jain sir?
Yes, sir. I think I'm also done with my questions, sir. I just have one last question, which is
Sure.
corporate assets. Then we would be done with it, and then just a carve out. So just two last questions. One is
no problem.
Goodwill we have discussed, sir. Now, like in case if we have a head office building, which is not generating cash flows in itself, but is assisting all the other assets in terms of all the other CGUs in terms of development, how do we do impairment testing for that? And how do we allocate loss in case if there is any impairment loss there?
I'll quickly answer that question. So, friends, basically, when we are running a business, we have to test for impairment, whether our cash flow would be present value of cash flow, that is my asset value in use, I'll be able to utilize their value. Now, this is true for, you can do it for a factory site, but what happens to the corporate asset? So broadly, the corporate asset is allocated on a rational basis to different CGUs. Say, suppose if you have 2 CGUs, 3 CGUs, say, for example, like in case of hospital, if you have a corporate building and then you have 10 hospitals. So you have to proportionately on a based on the carrying value or whatever the rational best possible factual position, then you have to allocate the value of the corporate asset to all the CGU and then test for impairment.
Okay.
Now, as far as the allocation of the loss is considered, so what we do is normally the impairment is tested on CGU basis. So whatever loss occurs, first the goodwill goes and the balance impairment loss is actually allocated to all individual assets based on the proportion of their carrying amount. Now, here also we have to understand one thing, that at many of the points, suppose there are certain assets who have also been fair valued under a CGU. So suppose there is a land which was fair valued, there is one particular car which was fair valued. So we have to see that then we have to retain that fair value inside the impairment allocation also. And the balance remaining, then again, we'll have to again rotate and divide it into the basis of or proportionate pro rata basis of their carrying amount. One another caution which we have to see is that after impairment, the value of the asset should not go below zero. Sometimes it may happen because of the proportion method that it may go below zero. So none of the asset value after impairment should go below zero. So those are the concepts. So in simple, over the proportionate, the impairment is to be allocated to all the asset in proportion to the carrying amount. And if any of the particular asset fair value or value in use has been evaluated, then we should not go below than that. The remaining value because of these type of asset then are again allocated, and none of the carrying amount should go below zero. That is the mathematical process to do it.
Okay. Perfectly fine. In fact, so it's simple that it is in proportion of carrying amount, except goodwill, which we discussed would be first to goodwill and then carrying amount of all the assets, including the
As a thumb rule. As a thumb.
Perfect. Right. So, and last question is, can we reverse impairment loss in any situation?
There is a very good example. Tata Motors did a 1400 crore loss and then reversed 1200 crore. So yes, it can be done 100%. So impairment Ind AS 36 is a mirror standard and a half valuation standard. So value in use is defined in Ind AS 36, and half of the major part of the standard is on impairment. But yes, we can also write back the impairment, and exactly what conditions are there for impairment, negative impairment, the same or similar methodology would be adopted for reversal.
Okay. And Adesh sir, you have anything to add on to this?
Yeah, absolutely right. Impairment reversal is possible, but for goodwill it is not possible.
Correct.
So if there's an impairment, goodwill is not possible. Other than goodwill, impairment reversal is possible to the extent of impairment loss recognized.
Earlier recognized.
Reversal cannot go beyond that.
Sure. And we will be recognizing impairment loss by debiting PRL unless we have a revaluation reserve on that asset where we'll use that first. So the reversal also would get credited to PRL itself?
Yeah. If it was generated through PL, that reversal will go to PL. If it was generated through OCI, will go to the same.
Go to OCI. Okay. Perfectly fine. So I am done with all my questions. Thank you very much for patiently answering all these questions. I hope the audience is also not impaired after such an intrigued discussion, and they've developed some intangibles on their own. So we can now take the audience questions. Pramod sir, you have any inputs, please?
In fact, thank you for the excellent session. Rajkumar Agarwal ji, Adesh Sharma ji for excellent deliberations, I would say. And of course, Sarthak ji for making the session so lively, the way you have been explaining and asking the questions, and even wherever required, you are giving your inputs. That has again added great spice to this whole program. We have already breached our time, but taking only one question. We got more than 50 questions, which cannot be taken at all. I'll be just taking the one question, and one question from one of the participants who posted the question prior to the start of the program itself. So it is from Pradeep Pal Singh from Peel London. Is that in case there is a machinery which is installed in the year 2016 with a huge amount, and since till date it is remained unutilized. So can the company impair the machinery by 100% of the cost without any valuation? So is it allowed? Point number one. Second, a company is having a raw material and WIP which is not utilized for past 5 years. So again, can this be I would say impaired? Can this be impaired? So this is the two questions, one on plant machinery and second is on raw material and WIP.
So I think we have one for each of the panelists. Maybe the first one, Rajkumar sir can take. And
yeah. So, sir, if we go theoretically, what happens is we have to find out fair value or value in use. Now, if it is not used and possibly not be able to use, the only way is that we fair value it. Now, in the case of fair valuation, also if it has not been used for say 4 and 3, 8 years, So probably it is more from an scrap angle. So it is more of a disposable cost. So actually we have to see the fair value, or we have to use that particular concept, and also the cost of disposal has to be deducted from it. The standard also give an option that either of the that means value in use or fair value. If you know that value in use would be lesser than the fair value, then you may not even evaluate it. So that option is given in the standard itself. So based on the fact, if even the fair value is used and then the impairment is done, that is fine. Still, if the company wants to do it 100% impairment, 100% would not be possible, because even the residual value would be there. So I think that will give an anomaly of the thought. So ideally, a small fair valuation should be done, and accordingly it can be worked out. Hope it should serve the purpose.
Thank you, Rajkumar. And Adeshji, as regarding raw material and WIP.
Yeah. So in respect to the raw material and WIP, will not discuss the same from the perspective of India statistics. We'll go to the inventory standard. There we basically value the same as per the cost or NRV. And basis that principle, will recognize the value. If value NRV is lower than the cost, will recognize the same at NRV value. In a way,
very.
This.
And you very rightly said, because that is AS2 or Ind AS2, not this 28 or 36. Great. Thanks a lot. Huge learning, and I really thank all the audiences, all the participants who are there, because they are still hooked up and they've enjoyed. And thanks for giving such great reviews on the question box also, which you have given. Excellent. And really, both the panelists along with the moderator have made the session very enriching, very knowledgeable, and as our moderator says, created a lot of intangibles today, right? The knowledge, and which cannot be valued, and which cannot be accounted for in the books. But great, thanks a lot. Excellent session. Thanks to Shalini ji and Kulshekhar ji also for the excellent teamwork. Thanks a lot. Thank you very much. And thank you also.
Thank you everyone.